Good morning, everyone, and welcome to the webinar. Before we begin, our NAIOP Vancouver President, Jason Kisselbach, will say a few words.
Thanks, Paul, and good morning, everyone. I'm Jason Kisselbach, President of NAIOP Vancouver, and we're happy to welcome you to the first of our fall webinar series this morning. Over the summer months, the NAIOP board conducted several meetings to discuss how we can continue to deliver on our mandate of providing quality education, professional development, and advocacy to the local commercial real estate community. As a result, we have several items scheduled this fall, including this three-part breakfast webinar series focused on trends in the various asset classes, our continued focus on advocacy initiatives, which are published through our government relations update emails, our annual cost of business survey, which is our scorecard for development costs and timelines in the various municipalities. This year, it will be focused on the office asset class, the biennial commercial real estate awards, which will be in a new format this year, and our Developing Leaders Mentorship Program. For more information on upcoming and past events, please visit the NAIOP Vancouver website or follow us on social media. Finally, I would like to thank our sponsors. Without their continued support, we would not be able to undertake these important initiatives for the local commercial real estate community. I would now like to turn the presentation over to Chris McCauley, Senior Vice President of Industrial and Logistics at CBRE and a 10-year member of the NAIOP Vancouver Board. Chris, over to you.
Thank you. Very strange to be doing one of these virtually, but I want to thank everybody for attending today's event. I'm being told that we have over 250 people, which is fantastic. Last time I did one of these events, I got to look out and see all of you. Now I spend countless hours staring at this computer screen. It really has amazed me how many things I've recognized during these times that I took for granted, and all the little things I would miss. And seeing and talking to all of you is definitely something I miss. I've tried to comprehend and describe what is going on in the world, and I just can't. The changes that we've all gone through and the impact it has had on some people's lives is shocking. But we are not here today to talk about that. What we are here today to discuss is something that has been positive and has actually benefited from the pandemic. I would say the industrial market hasn't just been resilient, it has actually flourished. And maybe even stronger now than pre-COVID. In Vancouver, after seeing a slight rise in vacancy in Q2, we are now back to historic lows. We didn't see the doom and gloom that many predicted. Today, we'll discuss why is this happening and is it sustainable? I have the absolute pleasure of moderating this panel of experts and friends. Each of them is a true leader in the industrial market. Their depth of knowledge and experience, not only in Vancouver, but across the country and the US, will help us truly understand the drivers of the industrial market. First off, I'd like to introduce you to Alireza Harandi, VP of Investment for Prologis and based out of San Francisco. Next is David Owne, Chief Operating Officer with Pure Industrial. Blake Asselstine, VP Asset Management at Beedie. And finally, Stuart Morrison, EVP at Colliers. Thank you, gentlemen. We have a lot to get to today. So let's actually just get right into it. This question is for each of you. Let's start with one significant impact the pandemic has had on your role within your company and a significant impact that you see in the industrial sector. Stu, we'll start with you.
Well, thanks, Chris. It's nice to see everybody. It hasn't really had a significant impact on my role in the company. It has had an impact in terms of not being in the office with my team for the last 6 months. But we've found different ways to collaborate, and we've been very, very productive. So, and COVID has been really, really busy for us. As, the industrial market is firing on all cylinders after probably a 4 to 6 week pause. And so from our perspective, we feel really fortunate.
Great. Blake?
Yeah, I would agree with Stu's comment. I don't think for myself and the role within the company, it changed much. It seems like just yesterday, even though it was 7 months ago, we were all at the JCC event and things were awry in the world. Jason Kisselbach was getting hit in the face with passes from Drew Brees and all was good. And then Trump makes a speech, things seem to go to hell, and NBA suspends action. And all of a sudden, here we are 7 months later. But, you know, at that time, we had a few call them canaries in the coal mine, some people that were starting to struggle, some signs that things were changing. And within the next, call it 40 days, we had 92 requests of rent relief, some issue going on with the tenants, something that we need to support them. And I know these numbers pale in comparison to the Cadillac Fairviews of the world or the major retail owners out there that were being hit with much higher numbers than that, higher volume. But we've got a pretty lean team here, and to have that volume of requests coming in, each having a unique challenge to face, it was really a collaborative effort from our team and the company of trying to get together and to manage those issues. I thought it was really interesting how the community embraced it too. You had John Middleton setting up calls to discuss what each group was going through and how they were addressing it. You know, I'm jumping on calls with other senior leaders at different companies to make sure we're all doing the same thing and working in the same method. So that was really interesting. And then just communication within the team here, you know, it was great to see.
David, what are you seeing in Toronto?
Yeah, I think generally speaking, we were a little bit isolated, you know, in that we're in the industrial asset class. We didn't go through what retail and office is going through, and to a lesser extent multifamily. But you know, there were still rent collection issues, and I'd say that the biggest stress was on the staff, and we're not equipped to deal with tenant requests in scale on a monthly basis. And I think rent collections and SECRA and all these programs that have been out there has put a lot of stress on the staff. So been a lot more focus in addition to their day-to-day. I think they've been focusing on, you know, rent collection, you know, administering the government programs that have been out there, and I'd say that's been the biggest burden throughout all this.
And Ali, I struggled at the beginning to describe what's going on during this pandemic here in Canada, and you being south of the border, I couldn't even begin to start. So, but what's the impact been like for you?
Well, personally, yeah, it's a little strange walking out in downtown San Francisco and every office building's empty and there's not that vibrancy that you saw before. But I'm sure you guys in Toronto and Vancouver are feeling the same way. Look, honestly, our business is, you know, after the first kind of month and a half, 2 months, while we were figuring out what the heck was going on and answering rent relief requests and trying to update the market on really what we thought was going on and provide some guidance going forward, we ended up getting really busy really quickly. And that was obviously the shift from a lot of our customers moving towards more e-commerce and more industrial space based on online sales. I would say how it affected me and some of my peers at Prologis, I think it really gave us more of an opportunity to work on things outside of the actual physical real estate and rent collection. It gave us the ability to leverage our scale to do a little bit more R&D, whether that's with our technology arm or our venture arm, and certainly be more customer focused because that's where we think the future really is, and that's where the puck's going to be going.
Well, it kind of leads me nicely into the next one, and let's see if I can get an honest answer here. Was it an overreaction at the beginning, and was there something that you would have done differently? Is there a renewal rate that maybe you panicked on and maybe did a little bit lower? Or was there a business decision that you made at the beginning of all of this that you know, looking back at it now, maybe considered an overreaction? Like,
you know, I got a perfect case study on that fact because we went out to a tenant back in December with a proposal to extend their lease, and of course there was that initial shock of the 50% rental increase, and so there was no comment back. December, things carried on. We got to March, April. Obviously, the pandemic started hitting. We were dealing with a lot of rent relief requests. This tenant in particular, their book was still busy, so they still had a lot of work on the go. And they came back in May and asked for, call it a COVID discount. And at that time, we weren't really engaging with any other tenants. We didn't want to be making new introductions or new calls to tenants asking about lease extensions, just given the amount of uncertainty there was in the world. So we'd hit a pause on that front. And when this tenant came back to ask us about that request, we just said, no, we're not prepared to discuss anything. We don't know where this is going. You know, yes, it's a pandemic. We don't know when the end is, but there is going to be an end to it. Things will correct and they will get stronger. So fast forward to September, October, we ended up re-engaging with that tenant, extending their lease. We hit higher rates than we had proposed back in December. Same starting rate, but we had higher escalators on it because through that process, you know, we had started, thanks to the Prologis and the Pures of the world, we started hitting tenants with higher increases in Vancouver that we hadn't done before. Usually it was an arbitrary 10% bump after 5 years. Well, now we're seeing these 3 and 4% lifts each year. So we ended up getting a better deal than we had initially proposed back in December. So I think that was a win for us, but we've still taken a pretty hard pause. I don't think we're fully through it right now. So we don't want to just start high-fiving and say everything's coming back, because I think there's still a lot of tenants out there that are struggling to a certain extent. You guys talked about CECRA. We engaged in CECRA as well. I know there's new programs coming out for the tenants to try and support them from the government. I don't think CECRA was for everyone. I think there's certain landlords that have different challenges they have to face and can't necessarily waive 25% rent, but it worked for us, and we passed it along to a lot of our tenants, and I think it was a benefit.
Do you think you've surpassed your predictions from when this all started?
Oh yeah. I don't think.
Now?
Yeah, we didn't know what was going to go on. I mean, it was doom and gloom for sure from the start. And a lot of our work and a lot of the stuff I talked about when I was first answering that first question was communicating with Ryan Beedie, our owner. I mean, just making sure he was in the loop of what was going on. And he was certainly concerned. He was dealing with a lot of other things beyond just our IPP properties. There's the development, there's the residential, there's all the other businesses that he has on the go. And, we were concerned. Certainly, we didn't know what was going to come of it. We didn't know how quickly we'd get out of it, but it seemed to be Vancouver was pretty resilient.
David, what about yourself?
Yeah, I think generally speaking, when April 1st hit, everyone was worried about what rent was going to be collected. And quite frankly, I didn't even know how much we collected in the first week. And obviously, when it wasn't 100% day one, there was concern in a lot of people's eyes. But as we kind of worked through it, I think we did a few short-term deals, but obviously we wouldn't have done that, today, but the rents that we achieved were well above market for that. So we feel like we were fairly compensated. But yeah, generally speaking, it's more about the duration of the deals that we did. I wouldn't say that there was anything concerning by any stretch. It was more about stuff that maybe we had bought vacant, that nobody really knew where the market was heading in March, April. And, we did good credit deals for shorter term, but probably those are the only two things that I could speak on.
And for David and Ali, what are you guys seeing in other markets? We get caught up here in Vancouver about how, it's been positive here on the industrial side, but is there pain in certain markets that you're seeing, an occupier sector, a size range, something like that?
I could start and take that. I think that the smaller bay stuff has been difficult for us in certain markets, especially certain pockets of certain markets like the Bay Area. But truthfully, it's been pretty resilient, Chris, as you kind of talked about at the beginning. We've had a ton of customer demand. We've had a ton of customer demand focused more on the last touch real estate that we call it, which is, as infill as it really gets in the urban core. A lot of our customers have seen this as an opportunity to really penetrate those markets and solidify their real estate presence a little bit closer in now that things have kind of tapered off. And a lot of the, your traditional tenants, right? For Prologis, we've got over 5,000 customers, unique customers. So we have everything from Amazon, which is our largest customer, Home Depot, FedEx, UPS, all the way down to your local, tour bus company or plumber. So we're seeing softening in those and rent relief requests in those size ranges in that tenant mix early on, and a real hunger from our top customers to get closer in.
Yeah, I would echo that, and I would just say the majority of the tenants that struggled, during COVID were industries in secular declines anyway. So retail, a lot of textile companies that just inevitably went under. You've seen the retail bankruptcies show up in the headlines. Automotive manufacturing came to a halt. So any ancillary 3PL or distribution services related to that was more or less put on pause. And a lot of these, smaller size, one customer type businesses really struggled. And all of the larger players said, okay, we're not paying you for 60, 90 days, 120 days in some cases during all this. So they were the ones that came knocking for rent relief. And that's generally pretty limited in our portfolio, but there's still a little bit of that on the smaller bay side.
So at the beginning of the beginning of the pandemic, some developers were capping projects or pausing. Is this the case now? Blake, were you guys pausing projects at the beginning? Are you going up full on spec right now? Where are you at?
Yeah, we certainly discussed the idea of capping some of these projects. I mean, there's a cost to doing so, right? Once you're under construction, to decommission and then recommission, there's a pretty big number that goes along with that. So we did. I don't want to fully speak in detail because I'm not on the development side here in the company, obviously. But yeah, we definitely took a pause on some projects, and through that, we hit a few home runs. Luckily, we had a couple projects we were watching really closely, and we got lucky and landed. Not to take anything away from our leasing team and the efforts they put into this, but we landed a project up in Gloucester, a 55,000 square foot build-to-suit that on a project we had capped and we weren't going to go ahead with. And I think the confidence that gave Ryan and the company to move forward on some other projects just trickled down. And so we're now going ahead on another project in Gloucester that was a little bit ahead, that we were starting to ponder whether we were going to do it or not. We didn't really have anything in the pipeline right now to be bringing out of any major scale. So I don't think there's anything that's really being impacted too greatly. Our strata projects are still cooking along with great activity. Through your support, we've almost fully leased out Coast Corporate Center. So things are still charging along, and I don't think there's anything that's really being shelved at this time.
David or Alec?
So much of our business is a built-to-suit business. I think over 50% of all the developments we do that we were full steam ahead on those, and we did not stop, especially for our larger customers. In terms of the spec projects, I think, once again, speaking from a Prologis standpoint, because of our scale, it's a little bit different. The spec buildings we're building is, the last building in a large industrial park, or a building we would have probably built anyways. So, were we disciplined? Yes. Did we appreciate the fact that our peers were also disciplined? Yes. I think when the pandemic started, our leadership realized that this is totally different than what happened, call it 10 years ago in the global financial crisis, where a lot of people were over their skis. There was oversupply. A ton of people were building when they shouldn't have been, and this market was totally different. And we realized that vacancy was lower than ever. And demand, we thought, was really going to pick up. And we were sensing that from our customers, right? When a pandemic happens, nobody really knows what to do. Everybody's scrambling to try to figure it out. I'm sure our customers were. And the ones that were most successful were the ones that can really, really act quickly and understand how to modify their supply chains. But I think we're really going to see a lot of activity coming up in the next 4 to 6 months as these companies have finally figured out how they're going to alter their supply chain. So that they're more resilient going forward. And I think that falls perfectly into all of our favors with just more demand and more leasing velocity.
I would echo similar to that. I mean, the development story, I'll speak to Toronto. I mean, there was definitely a pause on planned and expected supply, but deliveries continued. I mean, there was a construction shutdown, which has pushed out new deliveries here, at least, some 6 to 12 months. Municipalities are slower. They're backlogged. I think if anything, supply is going to be tighter coming out of this because of all this slowdown. But yeah, from what we've seen, we saw some people cancel some planned and expected, but nothing actually halted that was already shovel ready.
Let's kind of talked a little bit about what has happened. Let's talk about what is happening currently and what we're going to see going forward. Let's talk about the markets in general. I'm not going to throw up some slides or some data points, but most markets are still experiencing historically low vacancy. This question is for you, Stu, because I know a lot of the landlords on this panel are biased. What, in your mind, is a healthy or balanced vacancy rate?
It's hard to say. I think our market's unique from relative to other markets in North America. So the highest vacancy rate I've ever seen, and that was back in 2001 at the end of the NDP's last kind of 8-year reign. That was 5.1%, which by North American standards is pretty healthy. Obviously, 1.3%, our current vacancy rate, is very favorable from a landlord's perspective, but you still do need space to expand existing tenants and accommodate new requirements in the market. So for me, 3 to 4% is a healthier rate, and that's a rate as a broker we can start demanding more full fees. So we're happy with that.
I just, in case Ryan watches this recording, I would always say that no vacancy is good vacancy. So we want no vacancy. The reality is there's nothing worse than losing a tenant when you can't expand them within your portfolio. It's happened to us a couple times over the years. We've had great organic growth with our tenants in our portfolio and moved them from 5 to 20 to 80,000 square feet over the years. And that's always a great story. But if you don't have anywhere to move them, then, look to the deal we just did with you, Chris, where we expanded a tenant into a new facility we built, right? And then we can backfill their space when they come out of it. That's great. And if you don't build new buildings, then you don't have that opportunity. So you've got to take a bigger risk. You got to put the spec buildings up, and you've got to be prepared to eat a little bit of vacancy. And so, maybe a little bit's not the worst thing in the world, but yeah, no vacancy is good vacancy, Ryan.
I would definitely say the vacancy rate that we're at now hinders us, especially for new entrants to the market. And as you said, Stu, people looking to expand. At what points does other markets benefit from our low vacancy and our few opportunities? Markets like Calgary or Seattle or even Toronto. I shouldn't say Toronto benefit. I think they've got the lowest vacancy rate in all of North America. But when do these other markets, say Calgary or Seattle, benefit from what a lack of opportunities here in Vancouver?
So we had a tenant years ago in our portfolio go out to Calgary. They were close to renewing with us, and they went out and flew their broker, happens to be Stu's partner, out to Calgary and received RFPs. I'm sure from probably David. I don't know if Ali was in that market, but and went down the process. They end up renewing with us, and I just, we're back at that same time now. This is 4 years later, and they're coming up on renewal, and they're out there doing it again. And it's, for a locally owned company in Vancouver, I don't think it makes sense for them to just pack up and have all of their shipping out of Calgary. It's too hard. These owners want to have visual on their operations and see what's going on within their companies. Yes, a Home Depot can certainly do it, and a bigger company can relocate and take on that different market if they're prepared to eat the shipping costs. But for a private locally owned firm here, I haven't seen it much within our portfolio, and I just don't know how much it makes sense.
Stu, what are you seeing?
Pardon me, Chris?
Stu, what are you seeing from the occupiers you're working with?
Sorry, I'm getting some glitches on my end here. Back in the late 90s, we saw a fair amount of companies thinking about moving to Calgary at the time. They had a very, very favorable tax regime, healthy economy, cheap land, cheap labor. MBC was dead last in North America in pretty much every economic indicator that you can imagine. So there was an exodus, primarily of manufacturing businesses. We actually had a request earlier this week from an existing client to help them look at expanding in Calgary because they're concerned that they won't be able to expand here. How far that really goes once we look at transportation costs and labor studies, I don't really know, but I think ultimately they'll end up staying here. As Blake says, it's very difficult for locally owned and operated businesses to make that leap across the Rockies.
Let's shift over back to Toronto here for a little bit and talk about lease rates. Toronto is going through an aggressive growth, to say the least, over the last year. And, I believe deals in large bay space is now happening in $11 to $12 range, which was unheard of, a year or two ago. That would never have happened. What would that rate have been actually a year or two ago, David, on the large bay format? And where is it at now? And why is it going through the roof like it is?
It's really location dependent, but if you're looking at a generic big box, you're probably in the mid sevens. And today you're probably just under 10. And this is kind of tertiary Milton, Caledon markets. If you're more infill, Brampton, Vaughan, Mississauga, you're probably in the low eights then, and you're probably in the double digits, 11, 12 today. It's really a function of location and access to labor and transportation. Toronto is a huge, huge market. And I'd say that, with the transportation networks that we have, the intermodals, the airport, everyone needs access to all of those at the same time. So having the infrastructure in play really is what's most important. And rent at the grand, I know this is beat up at all these panels, but rent in the grand scheme of things is very small to a lot of these tenants. So being able to have access to labor, transportation, et cetera, the customer is just more important to them. And if you don't need it, you can get a $2 to $3 per square foot discount in the tertiary. But it's really not that big. You're starting to see, because of the lack of development, you're starting to see a little bit of a divergence from the tertiary as well.
So still some room to grow there. So Vancouver, we were on quite a run over the last 3 to 4 years. And, just before, I noticed just before pre-pandemic, call it a couple of quarters before, there was a little bit of leveling off in Vancouver. Stu and Blake, have we hit a ceiling in Vancouver? Are we going to pause? Is there going to be another run up? What's your thoughts on the lease rates of Vancouver?
Why don't you take that first, Blake?
I was hoping you would answer it first. No, we haven't hit a ceiling yet, obviously. I think we had certainly a big jump in recent months. There was a big step, 3 years ago, 2 years ago, where we finally leapt up into those double digits rates. There was a renewal done in Port Coquitlam, in Coquitlam. I think it was 50 or 80,000 square feet. And that was the first time I really saw something on a renewal jump up into the teens. There was no improvements. There was no amortization. That was just a straight up need from a tenant and an aggressive landlord. And that sort of broke that bubble for us, broke that barrier, I guess, to go into those higher rates. And we've used that and turned that into a lot of big steps for ourselves as well. So it's just a function of demand. And if that demand stays there, then we're going to be able to keep pushing those rates up. And again, you look at where land values are at now in Gloucester and Campbell Heights, those tertiary markets call them, and they're pushing. I don't want to get into quoting land values actually as a landlord. I'll get my wrist slapped, but they're big numbers. Chris and Stu, you got to tell us what they are, but they're huge. And to do leases on those pieces of land when you're selling them at those numbers, you got to have big shell rates. So I got to think it's going to keep pushing up.
And it's one of the things I love about industrial real estate is the real estate's not homogeneous, and it accommodates many different types of businesses. And those businesses all have different expense ratios that they're dealing with. And so it's really difficult to say, to make a generic comment in terms of rates going up. We have this new trend that's starting in terms of, initially it was onshoring a few years ago as supply chains were disrupted with trucking strikes and labor strikes in the West Coast ports. And this pandemic has been a massive supply chain disruptor. And so now you can see retailers moving towards just-in-case supply chain management away from just-in-time, and then so that whole model changes. And so it's very difficult to tell what kind of rent levels they can tolerate at this point.
Ali, when we look at it from a point of view, a lot of times in Vancouver, that we're very expensive. I just looked at the numbers. In the US, the average lease rate's $10.63 Canadian. And in Canada, it's $9.17. So, is a lease rate really that dramatic, say, in Vancouver compared to some of the other West Coast cities? Is it an issue for some of the occupiers you're dealing with? What's your views?
Yeah, it's a good question. And a lot of people look at it that way in terms of the larger national statistics. But, I'm sure that $10 rent you referenced for the U.S. includes, middle of nowhere Columbus. So if I were to, no disrespect to anybody from Columbus, but if you're to look at, call it the Bay Area, close in San Francisco and South City, which I'd say is, let's call it, Marine Drive or kind of Richmond, our rents are north of $20. And for big space too. There's just not a lot of it, right? But San Francisco has got very similar features as Vancouver. You're land constrained, barriers to entry. You got everything that makes it such a good core market. But I think the vacancy rate for so long, a lot of the conversions, we're seeing a lot of life science and biotech conversions actually in San Francisco, where traditional and old warehousing markets have really been converted, and we've seen the Kilroys or the Alexandrias and some of the larger REITs come in and convert some of the real estate. So that's put a lot of pressure on it as well. But I would say, I primarily focus on the West Coast and the Bay Area, but I would say our rents in Seattle are probably pushing kind of $18 especially for the closer in South Seattle stuff. And then in the Bay
US,
Area, US, correct. Yeah.
Wow.
And actually that was one of the funny things too, when we were poking our head around in Vancouver for a while. Blake, you brought this up. I mean, we were shocked to see some of the escalations and the annual bumps that was being used historically in the market. And I think that has a little bit to do with probably the ownership in Vancouver as well, where occupancy is really important for us. Sure, occupancy is important, but you know, a little bit of vacancy actually is good for us. We're able to push the envelope a little bit. And as David said, look, real estate costs, it's 5 to 7% of supply chain costs for our customers, right? The labor, the transportation, all the other operational costs are such a bigger piece of that pie that it truthfully, the rent doesn't really move the needle for them.
So maybe we'll start seeing some more premium on lease rates for buildings that are closer to those transportation or labor cores, instead of just blanketing a whole marketplace with a lease rate.
I can tell you that the number one, sorry, Chris, I can tell you the number one pain point for our customers is labor. And we don't see that trend slowing down anytime soon. So it's such a big part for our customers.
And I guess it's finding that balance to get close to the labor pool as well as close to your customers as well, getting that midpoint. Really quickly before we go into the drivers of the market, I just want to touch on strata quickly, Blake. Many would have predicted, not myself, obviously, that strata pricing would have leveled off or even maybe decreased 6 months ago. That has definitely not been the case. I think you've actually seen some significant growth. And aside from a couple of great listing brokers that you have, why do you think that is on the strata side?
Well, I mean, money's cheap, right? It's the biggest thing, and it's gotten cheaper throughout this pandemic. So when the first things first started getting rocky, our biggest concern was closing, right? Making sure that people had access to capital and could get their closings in. And so that, I know where our strata team was focusing their efforts on was making sure that the groups that had firm deals in place were going to close as they were contracted to do. But you know, our activity is strong right now, especially, well, specifically in this market. We've got buyers looking at 30,000 square feet. We've got buyers looking at 10,000 square feet and everything in between. So it's been very positive. If you look in Alberta, Calgary, the city of Calgary is being strong. It's been consistent. It hasn't been like Vancouver where you launch a product and you've got multiple bids and it's sold out within 2 weeks. But it's steady. And as we get into the project completion, we're typically selling out or at least 80% sold. You get into markets like Airdrie, sure, it's been a little bit slower. Edmonton, decent activity. In Toronto, we've got our first project completing out there pretty soon. And we've got one building sold out and working on deals on the other building. So for a new market for us, I think that that venture into that new market has been pretty successful. So it seems to be ticking along.
And I'll just clarify, your great listing broker was Casey Bell, definitely not myself. Let's go into the market drivers and the catchword that everybody uses, the e-commerce effect. It's easily the biggest driving force in recent industrial demand. Some are reporting that we've actually accelerated e-commerce demand by 10 years during the pandemic. What have you experienced in your portfolio? Does it continue at this pace? Is this actually affecting some of your decision-making on acquisitions or development? So let's just start with the landlords on the call, talking about, how has this experience affected your portfolio?
I can start with that. Obviously, throughout the pandemic, we've seen a tremendous uptick in e-commerce. You know, most of it's been short-term fulfillment requirements as a lot of retailers and companies figure out their supply chain. Grocery was a huge theme this year, and I think that's going to continue. I'll speak to kind of Toronto specifically, but Vancouver not dissimilar. Is they're starting to set up a hub and spoke model where you have the first and final mile as part of a complete supply chain, and that's not really been the case in Canada at all. So we're starting to see that bifurcation, which it means that when they go out to RFP, it's not just let's build a bomber in the tertiary and then hope to distribute to everywhere else. It's where are my spokes going to be within the cities, and we're seeing Sobeys. Sobeys is a great example of that in Toronto. They launched their Voila service. I'm not sure if it's out west yet, but That's been a huge success in the expansion of their whole retail chain. So I think generally speaking, we're going to continue to see that, and as retailers have to adapt and compete with Amazon, I think that's not a thing that we should ignore. They have to adapt to compete. The Canadian Tires of the world, the Walmarts of the world. It's going to evolve into demand for industrial space and warehouse space.
Like,
Yeah, I would echo that too. I mean, obviously, we've just recently done 2 big deals with grocery groups, not so much on the e-commerce side, mostly just their distribution facilities. But you talked about this onshoring, reshoring, I guess, of bringing back business and making sure that tenants were properly set up to have the supply chain need, or to avoid any supply chain implications that may come up down the road. I don't think from our IPP side of it, or income producing properties or existing portfolio, we've seen that so much, but I know on our build-to-suit side, we certainly field a lot of requests for 100,000 square foot plus bombers, and we just unfortunately don't have that portfolio, those properties available. We're not sitting on that stuff, and I know those tenants have an immediate need in the market, so it's tough to satisfy in Vancouver where there's just so little available product, and we're not sitting on the facilities that can accommodate them right away.
Ali, what are you seeing in your portfolio? Because you deal a lot with the e-commerce site companies, and is it affecting any of your decision making on acquisitions or development?
Yeah, so we've seen a lot of the supply chain adjustments generate some positive long-term demand, which we're pretty excited about. I think the accelerating of the e-commerce adoption, a lot of people talk about COVID as an accelerant to a lot of things. I agree that it's the same with e-commerce and diversified manufacturing locations that some members on the panel just touched on. But look, with companies shifting in shelter in place and e-fulfillment operations picking up, I think the stat was it accounted for around 40% of our new leasing activity in March, April, and May. So that's really, really significant. And we think, and our research team thinks, that it's probably going to amount to another 400 million square feet of U.S. logistics demand over the next 2 to 3 years. So I think those stats itself tell the story pretty well.
Yeah, I think the numbers here for Canada are 60 to 100 million square feet of industrial demand over the next 5 years across different markets on that as well. Can't talk about this without mentioning Amazon. They have been by far the most active occupier this year, with over 58 million square feet of new lease deals. What has this effect had on other occupiers in your mind? How long does this go on for? Ali, I'm going to start with you. Sorry, as I know you guys deal quite a bit with Amazon.
Yeah, so Amazon's our largest customer, and I guess goes to show how diversified we are. They only account for around 3.5% to 4% of our total customer base in terms of rent. So, but yes, they are the largest. What have we seen from them? So, I mean, there's only so much I can say, but they've definitely got a big appetite. I think a lot of our other customers look to them as well as the gold standard for how their operations and real estate teams really should be operating. Just the speed and the quickness that they operated at during COVID was pretty remarkable for us. They really saw it as an opportunity to start gobbling up more space. And we've seen them most active in our core West Coast markets, in the Seattles, in the Bay Areas, in the LAs. So they haven't slowed down. And one of the interesting shifts too, and it's been in the article, there's actually one a couple of days ago in San Francisco and in San Jose, where they're starting to spend their own capital as well. So they're out in the market purchasing real estate. And competing with some of us on this panel for some core real estate. So it's been interesting to see that shift. But I think that the most impressive thing from my perspective is their flexibility, their ability to adapt, and their ability to just act really quickly. It's refreshing to see for a lot of us.
And that's changed because Amazon first started their growth. They were very specific on what they wanted within their building and design criteria and things like that. Are you just seeing it now that they're just taking space?
That's a tough question to answer. because they could make a lot of different spaces work, and a lot of our tenants can make a lot of different spaces work. So is functionality a concern for them? Yes, absolutely. Do people start sacrificing functionality for prime real estate closer into the market? I think yes. So it kind of goes a little bit both ways. I wouldn't say if there was a building that's historically vacant, they would just gobble it up for the sake of gobbling it up. But certainly their appetite is larger than we've ever seen it pre-pandemic.
I think that's a really good point. I've noticed the same thing here. They don't just pounce on anything that comes to market, right? I've heard stories that they have a standing RFP on anything on the Inland Empire down in Southern California. Whereas here it's, you think you have a strong property and you shoot it over to them and you don't get a response. It's kind of shocking because you think that they're just ready to pounce on anything over 50,000 square feet, but it's not necessarily the case. But certainly they are driving rates up because they're aggressive and they're prepared to pay.
So you had a dealing with them out at iPort. What are you seeing as your point of view from Amazon?
Well, I think our market's interesting because if you go to the Inland Empire, e-commerce fulfillment is much more obvious because, and in any of the larger markets, the GTA is the same because you've got a much larger population base there. Whereas a lot of the e-commerce in our market, I would say, is integrated into traditional distribution centers, and there are less. I think just because of the size of our market, there's probably less scale here, and so you see less dedicated e-commerce fulfillment centers. Amazon going to iPort was interesting from my perspective. iPort, from my view, has always been an import-centric location, and so for Amazon to go to that location and staff it the way they need to, I thought would be a real challenge. So, but they're very innovative, right? They're running shuttle services to the SkyTrain. They're finding ways to get people there.
David, before we move on, Amazon.
Yeah, I mean, rumor is they've grown their footprint 8 million feet this year from 12 million prior. So they've been in full growth mode in Canada. That's predominantly been in Toronto, and I know we've seen some stuff come up in Ottawa as their eastern kind of distribution centers of the East. But we're seeing it in all of our markets, Toronto, Montreal, and Vancouver. They have a thirst, and they have multiple business units now competing. Historically, it was primarily just their sort business. Now we're seeing AMZL, which is their final mile delivery, which has really been interesting to see. And I would just say that they want the box and they want the utmost flexibility within the box. It's not like your typical lease, for sure. At least this is what we've experienced. They certainly want future flexibility to amend doors, to change things up, and I would say that that's the future with e-commerce fulfillment. I think you need to have flexibility in what you're delivering to your consumers, because that's always evolving, and as a result, from a landlord perspective, you have to be flexibility with your tenants.
I don't know if any of you guys will answer this question, but is there anything that would give you pause to doing an Amazon deal? Is there too much? Is there an effect that you wouldn't do, or maybe have some be cautious around doing a deal with Amazon?
Well, I think personally Amazon can be a challenging neighbor because, if you're a third-party logistics provider, typically Amazon is providing employees more flexible hours, higher wages. There are all sorts of other fringe benefits, and they draw a lot of labor, and labor is the biggest challenge in our market. I think it is in the GTA. Sounds like that's consistent in the US, and so that's a big challenge from my perspective.
I would say it's location specific. I mean, when you're in super tight infill markets like Toronto and Vancouver, they have less leverage with you to tell you how things go. I mean, that's just our views on it anyway. And if you get to tertiary markets like a Calgary, you're going to have 30 landlords bidding on the RFP, and it's going to drive the price down. I think it all depends on what you're offering to them, and I think they actually get that quite well, which is refreshing because they understand the labor, they understand the transportation, they understand the importance of both of those. And if you from our experience anyway, they've been pretty good to deal with in that regard.
I'm going to shift the focus over now. We're going to go and talk a little bit about the investment market. what I'm really curious about is what has changed in underwriting, what has changed in when you do your valuations, the effects of the current lending market, lack of data points, things like that. So, David, why don't you continue with that and just tell us what you're seeing as the changes in your underwriting?
I would say, for the next 12 to 18 months, and this is probably me speaking from April of this year, not really today, but, I'd say that we'd slowed down our growth profile on our rents. But that doesn't necessarily mean that we really amended our market rents across the board. So that's something that we were conscious of. Just we didn't really know how vacancy was gonna take up after all this is said and done, and until there's a vaccine, we really don't know what the future holds. So that's one thing that we definitely looked at doing. But again, in Canada in particular, institutional investment vehicles need access to industrial. They need to put money out in industrial. They're overweight retail and office, and the competition for industrial buildings is not going to slow. So I don't really see, generally speaking, I think it's kind of a blip, and I think we're going to see that, if there's supply available, which by the way there hasn't been, nothing's been for sale. But if stuff does come out, I think it's going to price pretty competitively. So.
Yeah, it's a good point. Like, we talk all about how great industrial is and how positive of a sector it is, and we all want to buy it. But if you have it, nobody wants to sell it, because what do you put that capital to? Blake, what are you seeing on the underwriting? So,
it's still very competitive in Vancouver. I don't think there was too much of a fall off on it. You look at the MECs of the world that came out. Stu, I don't know how many offers you guys had on that, but I know you were touring it for days. There was the Canada Bread property that. Several days of full blocked off hours of touring. So if you want to be successful in acquiring a property in this market, you really just got to pay the biggest number. At the end of the day, that's how we got Tillicum. We paid the most. So I guess in theory, we won that property, but it's, you got to be aggressive in Vancouver. You've got to get creative. It's either chasing things off market and hopefully having a good plan or a tenant in tow and something in your back pocket to make those work, because a lot of those properties, I mentioned Tillicum, like that was a very unique asset and it was a big number, and we needed to have a tenant to pay that. We did have that tenant in tow. That didn't end up panning out, but we got lucky and found a new tenant to backfill that. If you look at another property we bought on Annacis Island, we bought that with redevelopment potential and looked at a bunch of different ideas on it once we got into it, of just releasing the asset in its current state, because it was very unique. And now we're going down the path in a different direction on a build-to-suit on the site. So it's just a matter of trying to get creative and stirring up those opportunities in a market as tight as Vancouver.
Stu, what are you seeing on the underwriting and even on the valuation side when you're looking at things for clients?
I think MEC is a pretty interesting story. We did a lot of work with them through 2019 in terms of pricing their Western Distribution Center property in Surrey. In April, May, we were asked to reprice the property. I think their expectation was for the value to go down. We actually increased our guidance by 10% because there's a significant interest cost savings for developers. And on the strata side, we think low interest rates will drive the end values of those units up higher. And when we got into the process and received bids, we received 12 offers, and the pricing went up another 10% above our guidance. So that's as healthy a market as I've seen in terms of demand. Granted, it was a hybrid property, so there's an existing building that could stay or go. So there was appeal to income developers and strata developers. So there was a broader market, but 12 offers is really, really deep, and we were quite confident that the market was going to be there.
We're getting close to the end here, so I would be remiss if I didn't talk a little bit about multi-level industrial while we have Ali here from Prologis. So quickly, before we end up going to our conclusions and our predictions, I want to just ask the panel here a couple of questions on multi-level industrial. Is this the answer for markets that are land constrained? Where does it work? What do you need to make it work? Ali, I'm going to start with you, and if you can comment on that, as well as maybe just touch quickly on some of the highs and possible lows that you've learned from Georgetown. Everybody knows that project down in Seattle. It was kind of the benchmark that everybody uses and references when they talk about multi-level industrial. So.
Yeah, and I think I've toured a couple of you guys down through that property as well. It's the first modern multi-story in the U.S. But look, we've been doing this multi-story development for over 20 years, and it's been in more land-constrained markets, and it's primarily been in Asia. In markets like Tokyo, where the only way to go is up. The factors out there are a little bit different. Truck sizes are a little bit smaller, clear heights are lower. There's column spacing is definitely a little tighter. There's different functionality attributes, and what we were trying to do with Georgetown that we think we succeeded on was to really build a multi-story building where nobody would really realize it was a multi-story building, if you know what I mean, where the second floor is as good as an industrial building as any other building you'd find in South Seattle, if not better. It had all the functionality. All you had to do was spend 10 more seconds to drive up a ramp. That was really it. So, what things are important? Obviously, there's probably a handful of markets in the world that can actually work for this type of product. It's your core markets that you'd probably expect. Site layout, site size, tenant demand is all very important. You got to figure out if you want to bring a big truck up to the top. Do you just want to bring Sprinter vans? Do you want to have a bunch of vertical systems? How do you think tenants are going to operate in the future? Do they care about more clear height? So the thing that we're able to do at Prologis is we have a customer advisory board where we can throw our site plans in front of these customers and really get their opinion on where they're going, where they think this trend is going. I think that the difficulty for us is there's really only a handful of our customers that can really benefit from having multi-story space and infill space. And it's still more expensive than traditional warehouse space. So land pricing is not there yet, just because the construction aspect of it is so much higher if you really want to build a resilient building.
Yeah, and that's always my worry, especially with policymakers, is that they just look at multi-level or densified industrial as a solution to every market or sub-market out there for our lack of vacancy, and it's not the answer. It's very site-specific and very market-specific. Quickly, Stu, how do occupiers view multi-level from your aspect, from your point of view?
Well, as you say, Chris, I think it really depends on the location and the market. So if you go to the core distribution markets, we've got a lot of import and export distribution. I think this becomes a real challenge to go to multi-level industrial, and notwithstanding, geotechnical conditions, need flat land for industrial ideally, and most of our industrial land is located on a river delta with very geotechnical conditions, and it can be a real challenge from an engineering and cost perspective. I do certainly think that what Oxford is doing in South Burnaby makes sense. It's more of a last touch or a last mile location. There are always businesses in Vancouver that will pay a premium to be inside the bridges if their customers are downtown. A lot of their labor force is coming from Burnaby, South Vancouver, East Vancouver. So it certainly has its place, but it's multi-level industrial is it's not going to work everywhere in the Lower Mainland, that's for sure.
And Beedie and Pure, are you guys looking at building multi-level? Why or why not?
We would. We don't have the right. It's so location driven. We've already said that. Everyone on the panel said that already. It's so location specific. I don't know that we have the right site in our portfolio right now. But the rates are there to support it now, I think. So I haven't seen a pro forma on it, but I think we're certainly getting there with the massive steps we've seen in rates in the past couple of years. So I don't think we shy away from it. It's just got to be the right location and the right size, shape and size site.
I would say that as well. We would, but I think it all depends on functionality. To what Ali said earlier, you got to build it so that both levels are functional. If it's 2 stories, 3 stories, whatever it is, and that usually means you got to have a pretty large piece of land, and that's one thing that's lacking in kind of Toronto, Montreal, and Vancouver. So, for sure, if you can maximize density on a site, have a functional building, we'd be all over it.
Excellent. Well, guys, this is bringing us to our conclusion. But before we go, 2020 was definitely a great year, and a lot of us on this panel were very fortunate, with being in the industrial sector. All of you right now, can this continue into 2021? They say all good things come to an end. What are your thoughts? Ali, let's start with you.
My view in the U.S. is a little bit different than Canada. I remember all my trips up to Canada. It was funny to see how the global financial crisis didn't really have an impact on Vancouver like it did really everywhere else in the world. So Vancouver is pretty unique in that sense. I hate to make macro generalizations, but I will say that if you've got a ton of money and you're looking to place it, and you're historically looking to place it in hospitality, in hotels, in office buildings, in residential, you're probably not doing that right now. So you've all of a sudden allocated a boatload of money into the industrial space, probably life science, maybe data centers, or multifamily. So just from that level of looking at this, I'm fairly confident that cap rates will continue to compress. And especially as we see a lot of our traditional retailers generate more of an e-commerce style, e-fulfillment style business. I see it as really going as far north as you can. I'm excited to see what happens in the next 6 to 9 months in this space, because I think a lot of our customers are going to start making decisions, and you're going to see a lot more space being taken up and built.
Well, Ali, does that mean that we're going to finally see you in Vancouver, Prologis in Vancouver?
Fingers crossed. Fingers crossed. One day soon.
Yeah, get you back home. So I appreciate that.
Exactly.
Stu, let's go over to you.
Well, I mean, there are a lot of businesses that are of course, being negatively affected by COVID. You look at a business like Gordon Food Service, where their business is down 80%, right? Restaurant supplies, and there are definitely some challenges. But I would say in Vancouver overall, from a demand perspective, we're going to see more e-commerce fulfillment. Just in case supply chain management, if that really becomes a trend, we should certainly have a positive effect on demand. Film and television demand in our market's really strong. We're the second largest production market in North America now. And when we look at demand versus supply over 100,000 square feet, the current ratio is 4-to-1. So it's going to take a fairly significant impact for that to change. Now, when you look at that, the feasibility of that demand is questionable, because will Amazon be able to land their typical kind of 1 million square foot distribution center in our market? They've been trying to do that for a long time, and there are other large requirements that may not feasibly be accommodated in our market. But from that perspective, I think we're really, really looking healthy from the demand side. From the demand side, there's no supply side relief that we can see in the future, whether it's subleases, new land development opportunities, et cetera. It's going to be a real challenge going forward. And then we've got historically low bond yields. So I agree with Ali. Got very low interest rates, and cap rates have to compress further.
Blake?
Yeah, I'll try and keep it quick. I mean, I think there's still a lot of smaller tenants out there and different businesses that are still struggling and still going to take some hits, with SECRA drying up and the next program coming out from the government without too much information being announced. I think there's still quite a few groups that are being propped up by the government, but I think they're a small piece of the pie when we're looking at the total market here. So I think with that e-commerce and reshoring market out there, I think we're still going to be buoyed up pretty well for the next little while.
Let's conclude with you, David.
Yeah, I like to think of it as supply and demand. I keep it simple. In our major markets, there's not a lot of supply coming online, and land is becoming more and more scarce. And then development in general is becoming harder and harder in all of these municipalities. So, when you look at that, and then you see the tailwinds of e-commerce and really outside of Amazon, not a whole lot of penetration from the retailers of Canada. I think that's gonna obviously push and change in the next call it 12, 24, 36 months. And I think there's just strong demand for that product. So, you know, pretty bullish on rental rates and vacancy rates, and you know that'll result in pretty strong pricing as well from an investment perspective.
So another positive year for 2021. I think we all said that back in 2019, and we couldn't predict it of what happened. So hopefully 2021 is a lot less eventful for all of us. Guys, it was so great to see you and talk with you today. Everybody attending this call, I wish I could see you right now, but we can't. I'd like to thank all my panelists for joining me today and having this thoughtful discussion on a topic that's near and dear to me for sure. So thank you.
Thanks, Chris.
Thanks, Chris.
Thanks, Chris. Thank you.
Thanks, everyone.